Region, the less concrete, Fifth Third Bank chief economist, strategist Jeff Korzenik. Jeff, what do you make of, let's say, the mood of people in this country and shoppers in this country? It's an inexact science, but right now we're told that it's slipping. Do you agree?
Yeah. We don't read too much into consumer confidence surveys. They've notoriously had very little predictive power. What's much more important to look at is what's actually happening to incomes in the United States. They continue to rise. That's going to drive consumer spending more than sentiment.
But if you look at the confluence of all the data, and I follow very, very closely, most of it's been pretty good. Now, we might have come off highs in some cases here, but most of it's been pretty positive here. And I'm wondering whether that is a good backdrop for the markets, because certainly by comparison to any other economy on earth, I mean, we're doing okay.
Well, ideally, you want business investment and the consumer both heavily engaged. And we're in a period, because of all the uncertainty, particularly around trade and perhaps about the upcoming election as well, where the business community has scaled back their CapEx, their investment for the future. But the consumer is carrying the ball here. Consumer spending and interest in spending continues to be very good. To the degree confidence plays a role there, it may shift some spending away from big ticket items and more towards smaller items, small ticket luxuries.
Your sense of this flattening versus inverted yield curve and where we are now, I guess it's flatter now, more than it just being inverted, where short-term rates are eclipsing those of longer-term rates. But how much stock do you put in that? How long do they have to be inverted to get a guy like you worried?
I think it's fair to say that we take this sign already very seriously. The inversion of the 2 and 10 curve does precede recessions in post-World War II history. But what's really important to consider is how much time you have left. And our view this time around is that the negative interest rates abroad have probably dragged down the 10-year to some degree. And so the inversion signal this year is likely to be particularly early and perhaps, in a sense, premature. So we're already incorporating it. It's something we're keeping an eye on, but it doesn't tell us that there's a recession right around the corner.
I guess everyone seems to be expecting an additional quarter-point cut in interest rates in September. Are you in that camp?
We are reluctantly. We're not very enthusiastic, as you may know, about the Fed's policy of doing this mini ease. We think it is not a very productive policy and one that is fraught with some risks. I have to wonder what the Fed thinks of their policy already. They can't be very happy with the market response and the additional volatility. By its very nature, these mini easing cycles can't do very much, and particularly this cycle, where our problem is not fundamentally a monetary problem, it's more structural issues in the U.S. economy. Lower interest rates benefit a little, but you really have to weigh that against the costs of doing this policy and giving up future ammunition to fight a more significant downturn.
Thank you very, very much, Jeff. Good seeing you again. As Jeff was speaking here, we're getting some confused